They told you silver was boring. They told you there was plenty of supply. They told you prices were stable. That was a lie. Behind the scenes, physical silver is disappearing, inventories are draining, and the people who need real metal are starting to panic. Someone has been quietly cornered, and you were never meant to notice. Here's what they don't want you to see. Pull up your phone right now. Don't trust me? Search this exact phrase, COMEX registered silver inventory. Look at the number. Registered. Not eligible? Registered. That's the silver that can actually be delivered. As of late 2024, that number fell near 40 million ounces. Think about that for a second. The world's biggest silver exchange is backing trillions of dollars in paper contracts with an amount of silver that would fit inside a few semi-trucks. Now here's why that matters. 15 years ago, silver was treated like spare change. Banks used it to play paper games. Industrial users assumed they could buy as much as they wanted, whenever they wanted. Investors were told gold was money and silver was just a sidekick. So the system grew comfortable, lazy, overconfident. Then the story changed. Go back to 2015. Global silver mine supply was around 900 million ounces. Demand was strong but manageable. Prices stayed low. Nobody screamed. COMEX inventories were fat. JP Morgan was quietly hoarding physical while telling the public silver was dead. They were calm. You were distracted. Fast forward to 2020. Supply dipped closer to 850 million ounces. Demand didn't fall. It surged. Solar panels, medical use, electronics, investment bars, coins. At the same time, money printing went wild. Prices jumped, but still, the message stayed the same. Plenty of silver, nothing to worry about. They were stacking. You were surviving. Now jump to 2024. This is where it gets ugly. According to data published by the Silver Institute, global silver demand pushed past 1 billion ounces, while mine supply failed to keep up, sitting closer to the low 800 million range. That's not a small gap. That's a structural deficit. Hundreds of millions of ounces that don't magically appear. That silver had to come from somewhere. And it came from stockpiles, COMEX, London vaults, ETFs, drained. Here's the escalation. In 2015, the market had buffers. In 2020, it had cushions. In 2024, it has excuses. That supply deficit is now multiple years in a row. That's like spending more money than you earn every month and pretending your savings account will never hit zero. Do you understand what this means? Now here's where it gets interesting. Silver isn't like oil. You can't just turn on a tap. Most silver is mined as a byproduct of copper, zinc, and lead. So even if silver prices double, supply doesn't instantly respond. Miners don't care about silver. They care about base metals. That makes silver rigid, brittle, vulnerable. Meanwhile, demand doesn't care about price. A solar panel needs silver. An EV needs silver. A data center needs silver. AI hardware needs silver. They don't swap it out because the price went up. They pay up or they shut down. That's the trap. Now look at the numbers over time. 2015, silver around $15. Supply is near 900 million ounces. COMEX inventories are high. Calm market. 2020, silver spikes toward $30. Supply drops near 850 million ounces. Investment demand explodes. That's double the price in 5 years. 2024, silver struggles around the mid-20s on paper while physical demand breaks records. Supply is near 800 million. That's less metal with more people fighting for it. Now, registered COMEX silver near historic lows. Premiums on coins and bars are rareizing. Delays are showing up. That's not theory, that's stress. That's like having a fire sale sign on a store that's already empty. Imagine this. You've been saving in dollars for 10 years. Prices rose, your dollars stayed the same, quietly losing power. Meanwhile, institutions were converting paper into metal. Their dollars became assets. Yours became promises. They were preparing. You were trusting. JP Morgan didn't stack silver for fun. China didn't ramp up industrial stockpiles by accident. Governments don't suddenly care about critical minerals unless something is wrong. Silver is now listed as strategic in multiple countries. That alone should stop you cold. But wait, there's more. Paper silver trades hundreds of times the amount of real metal available. For every real ounce, there are claims stacked on top of claims. Futures, options, ETFs, promises. All are priced as if delivery will never be demanded. As if nobody will ever say, I want the metal, not the cash. What happens when someone does? What happens when a manufacturer can't get a supply at the posted price? What happens when investors stop trusting paper? What happens when the physical buyers panic? Here's what they're not telling you. Physical shortages don't start with headlines. They start with whispers, delays, premiums, excuses. Then suddenly, the price you see on a screen has nothing to do with reality. The paper says one thing, physical says another. And between late 2023 and mid-2024, something happened that changed everything. Between late 2023 and mid-2024, the quiet drain turned into a visible crack. Deliveries spiked, withdrawals accelerated, and for the first time in years, the system stopped pretending everything was normal. Here's what happened. Large players started asking for metal, not a cash settlement, not rollovers, real bars. COMEX data showed repeated days where more silver was leaving vaults than entering. That doesn't happen in a healthy system. That's like a bank where withdrawals quietly exceed deposits. At first, nobody notices. Then suddenly, everyone does. Now, here's the flip. For decades, silver was treated as a paper game. Banks could short it endlessly because hardly anyone demanded delivery. But when physical demand meets paper leverage, the math breaks. Every single dollar move up in silver creates massive pressure on short positions. Let me show you exactly why this matters. JP Morgan alone has been linked to holding hundreds of millions of ounces of physical silver over the years. Let's do simple money math. If an institution controls 100 million ounces, every $1 increase in silver price equals $100 million in unrealized gain. A $10 move, that's $1 billion. Now imagine multiple players positioned like this, while the rest of the market is still betting on paper suppression. Do you understand what this means? This is why the flip matters. The incentive structure changed. Keeping silver cheap no longer benefits everyone. Some players now benefit more from scarcity than suppression. That's when systems snap. Now look at the stress signals. In early 2024, COMEX registered inventories fell toward levels not seen in modern trading history. At the same time, open interest stayed high. That means more paper claims, chasing fewer real ounces. That's the definition of leverage risk. Paper promises multiplied while the physical foundation shrank. Here's what they're not telling you. COMEX prices are set by futures trading, not by people buying bars for delivery. It's a price discovery system built on the assumption that almost nobody takes the metal, but when that assumption breaks, the price becomes fiction. Now look at the paper versus physical gap. Paper silver might say $24 or $25 an ounce, but go try to buy real silver. Coins, bars, rounds. In many places, you're paying $30, $32, or even $35 per ounce. That's a 25 to 40% premium. That gap is not normal. That gap is stress. That gap is the market screaming quietly before it screams. But wait, there's more. This pressure isn't coming from one direction. It's a dual squeeze. On one side, you have investment demand. People are waking up, not traders, savers, people who watched banks freeze accounts, people who watched inflation eat paychecks. They don't want paper. They want metal they can hold. Small buyers don't sound dangerous, but millions of small buyers drain supply faster than a few big ones. On the other side, you have industrial demand. This is the part nobody can shut off. China is a key player here. China consumes massive amounts of silver for manufacturing, solar panels, electronics, and energy infrastructure. Solar alone uses tens of millions of ounces per year, and China is expanding solar capacity aggressively. They are not asking COMEX for permission. They are securing the supply. Now, combine that with governments classifying silver as a strategic material. That means stockpiling, long-term contracts, less metallis available to the open market, less float, less flexibility. This is the squeeze. Investors are pulling from one side, industry pulling from the other. In the middle, paper traders pretend the price is stable. Look at real-world price reality. In the US, physical premiums jumped sharply during periods of heavy buying. In Europe, VAT and supply constraints pushed prices even higher. In Asia, long-term contracts locked up metal before it ever hit exchanges. The paper says one thing, reality says another. That's not speculation. That's observable. Now here's where it gets uncomfortable. Silver is a tiny market. Compared to gold, compared to oil, compared to stocks, it's microscopic. A small shift in capital can overwhelm it. If even a fraction of global investment money decides silver is undervalued, there isn't enough metal to satisfy demand at current prices. That's why moves in silver are violent, slow suppression, fast explosions. They were relaxed because nobody cared. You were told it was boring. Now it's becoming unavoidable. Ask yourself this. If everything is fine, why are inventories falling? If supply is abundant, why are premiums rising? If silver is plentiful, why are delays increasing? Markets don't lie. They whisper first. And now the whisper is getting louder. But you might be thinking something right now. Didn't people try this before? Didn't silver squeeze attempts fail? Didn't prices spike and crash? Let me show you why this time is different. Yes, people tried this before, and yes, it failed. But they failed for one simple reason. The conditions were wrong, and those conditions no longer exist. Back then, silver demand was mostly financial. Traders chasing momentum, a few hedge funds, some retail excitement. When prices rose, supply responded. Vaults still had metal. Industry wasn't desperate. Governments weren't involved. It was noise. This time, the players are different. They had hype. These players have a necessity. They had leverage. These players have balance sheets. They had speculation. These players have long-term demand that cannot be turned off. That's the difference. Look at what's driving silver now. Solar power alone is rewriting the math. Each solar panel uses silver for conductivity. Global solar installations are expanding at a pace never seen before. Tens of millions of ounces per year are being locked into panels that will never be recycled for decades. That silver is gone. Forever. Now add electric vehicles. Every EV uses more silver than a gas car. Power electronics, charging systems, control units. Multiply that by millions of vehicles. That's another massive draw on supply. Then add data centers and AI. Servers don't run on hope. They run on electricity, conductivity, and reliability. Silver is used in high-performance electronics because nothing else works as well. As AI scales, silver demand scales with it. You can't optimize that away. Now layer on military and government demand. Silver is critical for defense systems, satellites, and secure communications. Governments don't shop for bargains. They secure the supply, quietly, long-term, off-market. Now ask yourself this. Where is the new supply coming from? Mining projects take a decade. Most silver is still a byproduct. Grades are falling. Costs are rising. Environmental rules are tightening. Even if prices spike, supply doesn't flood in. It crawls. Do you understand what this means? Demand is accelerating. Supply is rigid. Inventories are already low. That's not a cycle. That's a setup. Here's what they're not telling you. Silver doesn't need everyone to rush in. It only needs a small shift, a few big contracts, a few sovereign buyers. A few pension funds are deciding silver is insurance. That's enough. Now, let me give you something practical, things you can watch, real signals, no noise. First, the COMEX registered inventory, not total, registered. When that drops faster than price rises, stress is building. Second, physical premiums. When premiums stay high even during price dips, supply is tight. Third, industrial news. Watch solar capacity announcements, EV targets, and grid expansion plans. Each one is a silver demand promise. Fourth, China. Watch import data and strategic material policies. China doesn't announce panic. They act early. Fifth, price divergence. When paper prices stall but physical availability worsens, a repricing is coming. Each of these alone matters. Together, they paint a picture. Now comes the part nobody can make for you, the choice. 10 years from now, you'll look back at this moment, and you'll say one of two things. You'll either say, I saw this coming and I acted. I didn't need perfection. I needed awareness. Or you'll say, I saw it. I hesitated. I trusted the screen price, and I did nothing. Both are choices. Both have consequences. They were positioning while you were busy. They were acquiring while you were told to stay calm. They were thinking long-term while you were focused on next month. Silver doesn't ring a bell at the bottom. It disappears quietly. Then it reappears violently. If this opened your eyes, share this video with one person who needs to see it. Subscribe to the channel, comment, wake up below. The rest is up to you.